Previously on Stay in Your Lane.
So, in theory, all of these proposals for tax cuts and the spending aren't going to happen for almost a year, October 1st, which is true of the tariffs as well. The big an operative word in the tariffs is ratchet up the tariffs. So you might impose, you know, 10% on one country and they'll retaliate, and then you'll jack it up a little bit more.
Okay, so the pro growth policy is what is wait to see the impact of that, right?
Yeah,
All right.
yeah.
What's next? What's the next concern?
Well, yeah. So economically, it's two things. There's the inflationary effects of these policies and the growth effects. All the other stuff that's happening in the administration and the executive branch is sort of outside of my purview, if you will.
Right, it's ancillary. It's not, if you focus on policy, then you strip out all of the other stuff and you can follow the ball.
Right. It was interesting before. I'll say one last thing about the politics. It was really interesting going um, into the election that it looked like no matter who would have won the election, whether it was Trump or Harris, they would have been facing a divided government. That is a Republican Senate and a Democratic House. That's not the case. Turns out that the Republicans run the House too. So everything, all three branches are now Republican. In theory, that's going to make it easier for Trump and the Republicans to really run the agenda. Um, I think there's still factions that are going to clog things up. Not every Republican agrees with everything that Donald Trump wants to do, and there's still that caucus in the House that is, very much concerned about the deficit, rightly so. So they may gum up the works when a budget is formed or there are laws trying to be passed about taxes or spending. So it's not just smooth sailing, but it does give a bit of an advantage for the Republicans in running the agenda. Now, I'm going to switch gears, if you don't mind, here for a
No,
minute.
I'm ready.
All right, so that's the executive branch, which is the president, and the administrative branch, which is, sorry, the congressional branch, Senate and House. Right? Okay,
Right.
let's look at the switch gears to monetary policy. Everything I just talked about was fiscal policy. Let's go back to monetary policy, which is the Federal Reserve raising, lowering interest rates to influence the economy. There's an awful lot of talk about the Federal Reserve right now because they are in a cycle of lowering interest rates. A lot of talk. It's like the biggest thing that there is. And you have to step back for a second and say, you know what? Why does this matter that there are a bunch of people, on the Federal Reserve Board, on the Federal Reserve banks all throughout the country? What does it matter that they're going to lower the Fed funds rate by 25 basis points a couple weeks from now? Well, it matters. Suppose you're running a business, your business, or a trucking business, so forth. You have already cut the Fed funds rate by 75 basis points. You're going to be lowering all kinds of interest rates over the next year or so, influencing all kinds of interest rates. So suddenly, it's going to be that you can fund your business much cheaper. So, for instance, John Maley, if you want to do a project like buying, I don't know, new office or something like that, and you could do it at financing for 7%. Well, maybe that won't work. If it comes down to financing at 5%, then yeah, it might work. So it makes a difference as far as economic activity goes. Suddenly, you can either build the office or not. So it does matter what the Fed does, a little bit
Mm-hmm.
at a time. It
Yep.
takes time to work, but it does matter. Now, what we've been seeing as far as moving the Fed funds rate, we're in a cycle where it's ratcheting down, lowering interest rates, um, because what had been happening is the economy was slowing. So you want to lower interest rates to stimulate the economy. But what's happened now is that the economy is looking stronger than was expected a few months ago. So you're thinking, your Federal Reserve, well, I guess I don't need to stimulate the economy. It looks okay now. In addition, the Fed is trying to balance the strength of the economy versus inflation. Well, inflation has not budged.
Right.
So you don't want to cut rates from that aspect either because you don't want to reignite inflation. I'll give you a couple of quick numbers. I think inflation's still here, even though
Oh, I
the Federal
agree.
Reserve, yeah, even though the Federal Reserve is saying, inflation's slowing down, we're getting towards the 2% target. But I'll just run two numbers here at you. There are a couple different ways to measure inflation. One is the one you hear about all the time, the CPI, the Consumer Price Index. And I'm going to look at the core CPI, which strips out food and energy because they're so volatile month to month.
And they're
Gives us an
expensive as
underlying.
can be right now.
Yeah, yeah. So this core CPI has been stuck for the last 6 months between 3.2% year over year and 3.4% year over year. Been stuck. And in fact, last month ticked up just a shade. So that doesn't say to me that we're convincingly moving to 2%.
We're
And then the
2.5.
yeah, yeah. And then the other one that the Fed really looks like is this one called the core personal consumption expenditures price index. Let's just say it's another way to measure inflation. That's been stuck for 6% too. And it's been stuck between 2.6% and 2.8%. It's a different number there in the CPI, calculated differently. Don't worry about it. It's a measure of inflation. The point is, they're both stuck in a range. They're not moving anywhere. And in fact, last month they ticked up. None of that says to me we're moving convincingly towards that 2% target.
Right.
And 2% doesn't mean just hitting 2%. It means hitting 2% and staying at 2% or below for the
Right. You might see a
foreseeable.
1.8 and you might see a 2.2
Yeah, but you have to hit it and go there for the foreseeable future. I don't
sustainably.
see that yet in these numbers. So I don't think inflation's here. And I think what you were alluding to a minute ago was, yeah, inflation hasn't gone. Inflation is absolutely still here. And you're spot on about that because what people don't necessarily articulate or quite realize is that that inflation is cumulative.
Right.
So let's say in January 21, you bought a loaf of bread for $1, and then February it was $1.10, and then March it was $1.21 because it's cumulative and it's compounding, and all that is accumulated at very high rates, and it hasn't gone back down.
Correct.
So a rate of 2.5% year over year means prices are still growing. They're still growing on all that accumulated inflation already. That's why things still feel so expensive. It's because they
They
are.
are. Yeah, exactly.
Yeah.
Go to the grocery store. You figure that out real quick.
I go to the grocery store and I pick up a block of cheese, one of these blocks that could fit in your hand really easily. $10? Really? It
Yeah.
was dollars a couple of years ago. It was like 4.50 or
Four.
something.
Yeah.
Yeah.
And when they're
So
on sale,
price,
2 for $6.
yeah,
Mm-hmm.
right. So prices have not, they obviously haven't come back down, and they still are accumulated. That's the point. They've accumulated a lot over the past 3 years, and if you look at the accumulation of prices versus wages, wage earners are still underwater.
Yep.
Again, that's
Yep.
that's why it still feels expensive. They've made some gains, but they're still behind.
I would agree with you 100%. So what's the third part? We got inflation still here.
Right. So we talked about proposed incoming policies. We've
Fiscal
got
policy.
right fiscal policy. Oh, one last thing about the Federal Reserve. Yes, we've talked about why it matters and why they're cutting, but not, we look at the what I was talking about. The economy's not as weak as we thought it was. Inflation's not going down as much as we thought it was. So that says, you know, if I'm Chairman Powell, I'm going to do this one cut in December,
Then hold.
but then things are going to really slow down. Most economists for 2025 were saying, yeah, it's going to be 4, 5, 6 cuts. Now it's down to 2. Now it's down to 2. And again, that makes a difference. You're talking about a whole 1% when we're, in an area throughout the economy, we're working at 3 or 4%.
Right.
That
Well,
makes
at
a
the end
big
of
difference.
August, they said no cuts until maybe after the holidays, and then they came out 3 weeks later and cut it.
Yep. And in September, they made a pretty big cut, 50
Right.
basis points, and did another one in November. And it's widely expected they'll do another one in December. And then, it'll be
Hold
really
serve.
interesting. Yeah. It'll be really interesting to see what happens in the December meeting. I'm pretty sure there's going to be one more cut. But then the question is, what are they going to say? Because that matters almost as much as you have to try and figure out. And there's always a press conference. What are they going to say about future cuts? So that's almost more important. And again, it matters because of interest rates, all kinds of different interest rates.
Yep.
Now, I'll just mention one last thing about the Federal Reserve. I'm hard on the Federal Reserve because I really think when inflation started coming up, they really botched it. They waited
Yeah. They were
much,
too late.
much too late.
Yep.
So I ride them pretty hard, but you have to think of it this way a little bit. It's a pretty tough job in the sense that they've got to adjust interest rates to balance inflation and the strength of the economy. So let's say typically when inflation is higher, the economy is higher, you would typically raise rates to bring all that back down. Well, if it goes down too low, inflation's low, the economy's really cool, well, then you've got to raise rates and stimulate the economy. It's a constant thing out.
Yep.
The trouble is, geez, if you know what inflation is today and you know what the strength of the economy is today, that's a cinch. Just set rates. You know what it is today and what the effect will be today. It'll take effect right away. Well, the Federal Reserve has to make that interest rate adjustment depending on what happens a year from now. A year from now, and I always go back to the analogy of driving a truck. Suppose you know what the conditions are right now. There's a traffic jam in front of you, you put on the brakes. Highway's open, need to make time, you put on the gas. That's fine. You know the conditions now. What's the road going to be like a year from now? Should I put on the gas now or put on the brake now, depending on what the road looks like a year from now? Is our conditions going to be faster, slower, traffic jam? Is it going to change direction? That sort of thing. And almost more importantly, is that the economy is driven by people, and people are emotional and irrational, so they can be very hard to predict. So, again, if you
Yes.
can predict what the road is going to look like, maybe it's an easier job. If you're relying on somebody to build a road what way you expect, then it's a little bit easier to make decisions.
Continue watching on the next episode of the Stay in Your Lane podcast.